am Carlo Bustos, Educational Programs Leader at Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone today to today's webinar, Planning and Forecasting Best Practices, Processes and Technology that Drive Accuracy. Planning and forecasting are top issues for CFOs and finance professionals everywhere. In this webinar, our speakers will focus on identifying practices in people, processes, and technology which can be applied to companies of any size, as well as discuss some of the real-world financial planning and forecasting issues from a practitioner's point of view. I'd like to take this time to thank Proformative for helping us make this event possible and their generous support, for which helps us deliver this webinar at no cost, just like everything at Proformative. And now just a few housekeeping items before we get started. I'd like to welcome you back to Proformative. Just a brief overview of Proformative for those of you who may be new to our community. We are the largest growing online community of finance, treasury, accounting, and related professionals. We are an ad-free, noise-free community where we encourage and expect peer-to-peer collaboration. Check it out at proformative.com. Now some event notes. The links to today's presentation and the recording of this webinar will be sent out to all of the attendees within 24 hours of the event. The presentation is currently posted on proformative.com/resources if you'd like to download and follow along. For those of you who'd like CPE credits, you will need to answer all 3 polling questions during today's event, and you should have pre-registered for them. If you have any questions, please contact Chris Brower at proformative.com. We definitely encourage everyone to ask questions, and so we'd like for you to definitely leverage the questions section in the GoToWebinar control panel during the event. We will do our best to get to every question during the Q&A session at the end of the event. If we do not get to your question, we will make sure that we get the speakers to respond back to you directly after the event. And lastly, we will be asking you to take a quick survey at the end of the webinar. We greatly appreciate your feedback regarding the event today and the content, and anything that you do say, it's always best for us to utilize in getting better at delivering the content you are looking for. Briefly, just some learning objectives that we'd like to get accomplished during today's webinar. After participating today, you'll have a better understanding of planning best practices in terms of the common mistakes, as well as tools and techniques that offer better results. Also identifying potential areas of revenue planning and rolling forecasting improvements at your company. Lastly, learning how you can right-size technology to improve forecasting accuracy at your company. Okay, let's get started, and it gives me great pleasure to introduce today's first speaker. It's Dallas Moody. Mr. Moody is a director with Carlson Management Consulting, where he is responsible for providing advisory services and project management for Carlson's ongoing system implementation projects, as well as serving in outsourced FP&A leadership and technical accounting roles within Carlson's client base. Prior to Carlson Management, he was a manager of FP&A for Crossbeam Systems, where he was in charge of the administration of organizational planning and forecasting process, as well as the coordination of the annual budget, preparation of quarterly board reporting, as well as technical guidance relative to equity-based compensation. Mr. Moody also worked as a consulting manager for Corporate Finance Group and began his career at KPMG as an assurance associate. He is a certified public accountant in the Commonwealth of Massachusetts. Take it away, Dallas.
Thank you, Carlo. I appreciate the opportunity to present once again with Proformative, and I look forward to presenting best practices within planning and forecasting to the community here. So within this session, my goal is to ultimately take everyone through the traditional planning and forecasting process and what's wrong with it, and then also walk through a few key best practices in planning and forecasting, and then leave everyone with 5 key takeaways that they should start getting within their forecast, getting right within their forecasts for 2013 and beyond from a budgeting standpoint. As Carlo has already introduced me, I will not belabor the bio. So the traditional forecasting process is a extremely linear process for those involved within it, and I think one of the biggest problems is oftentimes management has already come up with kind of like their goals and their guidance, and we pass it down, folks come back with a number, and it's generally not very well linked with strategy, and oftentimes the folks down below have a different view of the priorities than possibly what's being passed down from the top, and oftentimes are given unrealistic goals sometimes from a guidance standpoint that don't necessarily align with the company's strategy. And I think Jack Welch has some great thoughts on the budgeting process. The budgeting process at most companies has to be the most ineffective practice in management, and it is the bane of corporate America. Two great quotes there. Typically, the budget lacks, once again, alignment with strategy and generally motivates the wrong behaviors amongst those within the plan, the actual budget managers that are in charge of planning. Oftentimes, they are focused on, at the end of the time frame, ultimately spending what is in their budget, or they pad their budget in such a way that they know that they're going to come under so that they meet their own personal comp targets from an expense standpoint. Generally, budgets are so focused on being built out in spreadsheets. Over 66% of companies still budget primarily through spreadsheets, that the ability to update, to do scenario planning is near impossible. And during the budget time frame, 10 to 20% of senior managers are spending their time, with budget-related tasks, and then 50% of the planning department time is spent on budgeting-related tasks. I know personally during my times at Crossbeam that, my first budget cycle was pretty difficult just from the standpoint of kind of coming up to speed with how the budget cycle worked. But then the year following, I was able to implement a lot of what I consider best practices, and the budgeting cycle was not that terrible. And also, as I was involved with the board reporting for the quarter end, we had been able to make it to where that it was really not as tough a time for me at that point in time as it was the year before. And the budgets generally suffer from rapid obsolescence. A lot of times you have made out a plan, and it was based on a certain sales target, and by the time you're going through the fourth quarter, you start seeing either weakness in the sales cycle, or you've totally changed direction, possibly on the R&D front. And so by 8% of budgets are often obsolete before the year begins. 33% are obsolete 1 to 3 months in within the year, and then 67% of budgets are completely obsolete within 4 to 6 months in. And when you consider the time investment that's generally involved with coming up with a budget, sometimes it takes people as long as 3 months for a planning cycle, that ultimately, you're not getting a lot of bang for your buck, I guess, when it comes down to budgets. So without further ado, I will now present a few key best practices. I think the first thing that all companies should consider is ultimately aligning their plan with the business priorities. And I generally think that the best way that this can happen is first through generally having a offsite of your key strategic leaders, and then those strategic leaders should come back and share the key components of those strategic plans with their budget managers, and should be very clear on how they intend to get there, and they should also share kind of the financial guidance that is going to be passed down from the finance department that aligns to that strategy. My suggestion is to kind of come up with what you expect your guidance to be before the strategic offsite. That way everybody can have an actual come to Jesus moment as far as discussing what the desires are within their budgets and whether they can meet those financial guidance targets that are being delivered to them. And then you should be looking at your departments on the basis of comparables within the industry as you start setting your expense goals, and make sure that people's expense goals are aligned with metrics and the comparable expenses from other companies. And then once you've started moving through the year, you should revisit planning and the strategy throughout the year. Ultimately, you have to consider long-term implications when you're building out a plan, and just setting a budget is one thing, but you would also want to look at the long-term planning aspect. And one of the things I will discuss later is the desire to start moving towards a rolling forecast, because this really focuses you on thinking into the long term as far as how you handle your business and budgeting planning. Already, companies are focused generally on the next quarter and rarely on the accuracy of, projections that they're going all the way out, 4 quarters sometimes. And in many ways, your most current quarter is really, what everybody is focused on, and so it's kind of frustrating from a budgeting standpoint if you're not aligning your long-term plan with your budget. That ultimately, that is another reason why they're obsolete within the year. The typical budget process is the executive team comes up with the goals, finance comes back with, guidance, and then that is passed down to the department managers, and, their bonus goals are tied to an expense that they may not even really have had that much control over what they were going to come up with. Ideally, those departments should be aligned with the strategy, and they should be coming up with the budget that is directly, aligned to the strategy that they have been tasked to engage in, and that they should not be given, unrealistic goals from finance that don't tie into the strategy. So ideally, it's more of a cyclical rotation versus a top-down management style. Within the budgeting and planning function, there needs to be collaboration across the department. All too often, department managers are given a finance contact that is their, business partner, but sometimes that doesn't really happen. The business partner is more just policing the expenses and is focused on trying to somehow incorporate all the actuals and then, get it to match up to their guidance. Ideally, you want to put into the hands of the users a system which allows for you to build out your plan and allow those users to do their own plans that's functional and that doesn't run into the technical issues and the linked files that you run into within Excel. So building out a system that, gives people the capability to make their plans is the most effective thing you can do to increase collaboration within an organization. Typically, most people come up with a financial exercise, and then they get the budget owner input, and then they try and manage everyone just to those 2 lines, or to those 2 dots. Once they've kind of given their budget owner input on whether the budget's realistic or not, sometimes they ignore the budget owner input, and then they still try and hold them accountable for a number that they may have not really even had input on. Ideally, you want to live in a different sphere. Basically, you take the arrow that we just looked at and you flip it. And so you empower your budget owners first by giving them a strategy and allowing them to collaborate in the development of the operating plan. And you do that through systems or through changing the process so that once you give guidance, you are open to receiving feedback that may be counter to what your guidance is and not just trying to hold everyone to a number. You develop a culture of accountability to that number, ultimately based on the guidance that they had direct input on. And then it becomes a financial exercise merely of pulling in the actuals. But it should not be driven first by a financial guidance that does not tie into the reality of the strategy or the operating plan that's out there. The typical way people handle the budget, and this is driving towards the concept of a rolling forecast, and basically constantly doing a 4+ quarter outlook when you're building out your plan, is most people are budgeting and they consider it a very linear process. If you're a calendar year company, coming in August, you start thinking about your templates and everything that you're going to send out to your budget users. You start revising those. And then by October, everybody's on board and everybody's in the budgeting process and everybody's focused, sometimes for a month, pencils down trying to come up with their budgets. The way it should become is it should really be a matter of almost a monthly to quarterly reforecasting process. You review your goals that you set out, you adjust your targets, and it becomes more a matter of looking out constantly at 4 quarters. That way, by the time you are coming into October, you really already know at least what your next 4 quarters are, and you only have to flesh out, the 5th quarter there, so the Q4 of the next year, or ideally, if you're thinking 5 quarters, then your budget's kind of already set, and you just have to review along the strategy and make sure that it still makes sense. And you're going to require a little more detail in your budgeting process than you would on your standard forecasting process. And the reason for rolling forecasting is, quite frankly, that the current business environment is just so dynamic. Ever since, really, 2008, I feel like people have not necessarily had a clear direction all the time as to where their businesses were going to be heading. I know that at Crossbeam, it seemed like sometimes our best laid plans were laid to waste, and we ended up having to constantly revise how we were heading within the forecast, and it was oftentimes driven, obviously, by sales backlog. That would change how we looked at the business. And one of the beauties that we had, the beauties of the way the system was built out there, was that we had a system that allowed us to constantly look and revise based on if sales volume was weak, what would we have to do in order to realign the business within that quarter, and then also we would have the details easily reportable from that system that would give us visibility into how to make our targets for the rest of the year. So one of my first steps that I would suggest is to constantly add a quarterly review to your process, to your forecasting process, and then use that information to supplement your annual budget process. So if you start seeing that one department is constantly over-projecting their non-reoccurring engineering expense or outside services spend, you know to kind of discount somewhat the numbers in the annual budget process, or to at least look at them a little deeper and validate those with the budget owners. Number 4, I think, is to reduce the cycle time. And by reducing cycle time, what I am meaning is to build out a component that's within the system that allows you to pull in actuals quickly and to make it make the data relevant when someone is looking at budget versus actual variance. If you are all the way halfway through or 2/3 of the way through the next month, the information you're giving someone is completely useless as far as their ability to make decisions. So you have to be within a certain time frame in order to make it useful for the users. I think if you're over really 8 working days, the data doesn't make sense, and it should generally always be analyzed against the forecast, not even a budget, because as we've already stated, the budget's generally obsolete within that time frame. Again, another key component in best practices for planning is to realize that planning and forecasting should never equate to accounting. Sometimes a simple statistical model will be more accurate than a highly complex model. One of the problems is it lures you into overestimating the accuracy of your plan, or also to build out an overly intricate model that comes up with relationships which sometimes do not correlate to what reality is. So basically, the 80-20 rule: target the large accounts, headcount, marketing programs, outside services, and non-recurring engineering costs. Focus on the numbers that mean something. And then rationalize your number of accounts. I think if you're getting to where you're trying to track everything related to postage, you're probably you need to look at subgroupings. And if you're trying to track everything to every single GL account, you're going to be struggling with the details for days. So in summary, you want to first align your budget with the business priorities, which allows you to create greater strategic value, retain the links to strategy and business vision, And you want to drive collaboration. And ideally, that comes through a system that underlies the whole budgeting process, and it allows you to execute more effectively and more timely, and then also to hold someone accountable to a number that they planned, not that a finance person came to them and told them that they had to meet. And shift it from a process to a cycle. That way, it becomes kind of second nature within the business that they need to just look at this on an ongoing basis and revise their plans, and it will improve someone's business decision-making in that way. And then reduce the cycle time on how you deliver actuals to people. That way, they start thinking on a more current basis as to how their actions happened in the previous month, and they will, act accordingly. And then finally, balancing the level of detail within your budget so that folks can focus on analysis and not purely on gathering up data points in order to plan. And then 5 things to get right for the year is to first start with, aligning the business strategy to budgets. And I would say the best way to do that, again, is through offsites and then having that process cycle back into aligning the expenses and the operating plans to that business strategy. And then start developing a rolling forecast. Don't just plan to a wall. Don't plan to the end of the year. Start planning 4+. And then, again, build out systems and the abilities for people to collaborate within their budgets. So allow someone to come up with their budget through a system, supply it to you, and then you come back to them with input as to whether it's accurate or not. And then finally, use a system that allows you to ultimately plan for multiple scenarios. Being able to quickly look at what your actuals are, and then being able to also look at kind of like your expectations and being able to model out what needs to happen from a cost savings standpoint. Can it be done just through cutting outside services? Can you meet expense goals that way, or can it be that you have to also look at potential cost savings through headcount reductions or delaying hires, things like that? Being able to plan for multiple scenarios, and to the way I've heard it put is you have subway timing, so are the trains running on time, and then you have coconuts falling from the trees. Being able to plan for the standard scenario modeling, varying scenarios, and then also for the total unexpected. Build out your scenarios to where you're looking at both sides, for multiple sides of the business dynamics when you're building out your plan. Once again, I would like to thank Carlo and Proformative for allowing me to present, and I will now pass control back over to Carlo, so I think he can ask you a polling question.
Thank you, Dallas, for those interesting insights and best practices. Really appreciate you sharing some of those thoughts. And as Dallas mentioned, we are on to our first polling question out of 3. I will be launching this, and you should be seeing this on your screens here momentarily. And a small reminder for those of you who are attending today's webinar for CPE credits, you must take all 3 polling questions to receive full credit. But we urge all participants to answer the polling question, as it is statistical in nature, and if we have enough time at the end of the webinar, we will hope to share some of the results with you. At this time, I also want to just remind you to use the questions box in your GoToWebinar panel to go ahead and ask some questions. I know we have a couple already, and we'll definitely try to get to as many as we can in the Q&A session. So I'll just give everyone a second or two here and close this up. And now I would like to introduce our second speaker of today's webinar, Paul Vickers. He is the Vice President of Finance and Administration for Parteq Innovations. Paul is responsible for finance functions of Parteq Innovations and GreenCentre Canada, where he provides professional accounting and tax services for these companies. For more than a decade, he has applied his expertise to helping innovative technology companies grow, with responsibility for all of their accounting, taxation, and financial reporting controls, as well as monitoring licensing agreements, equity holding, and banking relationships. He is a member of the Institute of Chartered Accountants of Ontario and is a certified public accountant in the state of Illinois. The floor is yours, Paul.
Good afternoon. Thank you, Carlo. So, Carlo mentioned I am a bit of background on Parteq Innovations. Parteq is the technology transfer office for Queen's University. We commercialize intellectual property coming out of the university and trying to find market opportunities for it, to take it from the lab bench to the market. I also have a second job as the Director of Finance at GreenCentre Canada. GreenCentre is similar to Parteq in that it turns research into commercial opportunities, but it is focused on green chemistry and materials, commercializing those opportunities for research institutions across Canada. So, challenges with our financial planning. It's highly volatile and speculative. While we're hosting this webinar, I can have an email that can add 6 digits to my budget or easily take it away. It is a continuously evolving financial plan. I cannot base our budget on history. We can have windfalls one year and be rich and poor the following year. Every product we sell is unique, and it's usually to only one customer. We're commercializing a piece of intellectual property and finding a home for it. And that property, that piece of intellectual property has its own risk profile. It can take 10 years for a drug to get to market, or it could be a quick win. We find budgets get out of date very quick. And that's the nature of our business. Dallas referred to how quick budgets get out of date from approval. My budgets can be out of date by the time I wake up the next morning. We have another problem on cash flows. Our cash flows do not match earnings, so I could be great earnings but no cash, and vice versa. And we're also growing, so how do you deal with financial planning in the growth and expansion context? Life before we got into a CPM solution, when Dallas was going through his presentation, he might as well put Parteq in as his case study. We were Excel and Access database driven. We only did it once a year. So time I was getting to months 9 and 10 of a fiscal year, I had no idea if I was going to have a cash crunch problem in month 1 of the next fiscal year. I couldn't explain variances. I couldn't hold feet to the fire. We were getting financial reporting out to management the 3rd week of the following month, and then it was just too late. It was not useful information, which took the finance department significant time to develop. Why we went with a CPM solution? These are the quotes lines I kept hearing from my bosses, from department managers, from my finance team. We can't be the only ones. We're not unique. We've got other businesses are having these problems, so how do they solve it? Which was catalyst for why we started looking at CPM solutions. And there has to be an easy way of doing this, which was the Excel problems. We had humongous Excel spreadsheets. And no doubt many of you do too, when they just run on for pages and pages, and then you've got an error on the 20-second worksheet on cell K5 that causes you to be out of balance. I got told that the finance department could not be the largest department in the organization. I'd like it, but my boss wasn't going to let that happen. Back to the cash flow issue. The boss is asking, where did the cash go? When we have great earnings but no cash, why is margins out of whack? So now we move on to life after CPM implementation. So now we've got it implemented. What's life like? It's happier. We've got a happier management team, happier finance department, and we're doing more with less. I can hold feet to the fire. We could do what-if forecasting. Back to Dallas's presentation, we do perpetual and continuous budgeting. There is no longer a one-year budget cycle. So let me give you an example, license revenue. We've got hundreds of license agreements, each managed by a commercial manager. They're for different technologies, different risk profiles. History is not indicative of the future, and we have to pay a cost for that intellectual property, and that cost varies. So how did we solve it? We leveraged our license database, and for argument's sake, that is our CRM system. We combined it with our ACPAC database to get actual historical data combined with the licensed information. We got it all brought into one place. We had the commercial managers feeding information on each of their technologies, letting us know about the risk profiles, and we were able to do more useful timing and planning of our licensing revenues. A second example is on scientific services. GreenCentre Canada hosts a wet lab facility, and it has a dual mandate. One is to do profitable scientific services, and the second is to provide lab services on academic discoveries. So we've got a capacity issue. We need to be able to use the lab to bring in profitable services to pay the bills, but we do also have a mandate for the altruistic side of our organization. So once again, we bring all these multiple variables into one solution, into a profits detailed planning cube, and that allows us to do the typical revenue and cost analysis and gross margin analysis, but it also allowed us to do capacity, both on physical resources and human resources. So lessons learned 4 years, 5 years later after getting out of the life of Excel spreadsheets, where it was get a consultant in. You may be tempted to do this yourself. We did get a consultant to help us out, and that paid off. My lesson learned on that, and what we did was shadow the consultant. Don't send the consultant away to go give you an almost a turnkey solution. Understand what they're implementing, how they're implementing it, so when you take over, you can know what you've got and you can keep growing on it. That leads me to make sure your solution is scalable and expandable. We're growing, and we went through some learning curves on this. Keep adding, make sure you design it so you can keep adding to it. Keep learning. If your vendor has education sessions on their product, attend them. Learn all the features of it. I know with Proformative, it's a great product and we've got it fully maximized, but this keeps being more and more where I say, we can now do this and get more benefit with less work. So a few final thoughts from my end. So this is how much I've embraced CPM. If I was going to leave Parteq, I wouldn't leave to a company that didn't have a CPM solution. I was unwilling to deploy one. I would begrudgingly go back to Excel. No way. It's just a history of the past that I don't want to revisit. The other one is the finance department is now value added. We're not in necessary evil of doing business. There's the finance department, and the boss has to pay some payroll for it. We add value. We're contributing to the success of the organizations by providing timely and useful information to the management group for running these organizations. So I will leave it at that and turn it back over to Carlo for a polling question.
Thank you, Paul, for that great story and kind of sharing your experience and history. Hopefully this resonates with a lot of the audience. And I know we have a few questions now in queue. And so before we get to our Q&A, now is the time for our second of 3 polling questions, which I am launching, and you should be seeing on your screen here momentarily. And again, at this time, I just want to remind everyone who is here for CPE credit, you will need to answer all 3 of the polling questions in order to receive full credit. As I mentioned, we do have a good set of questions in queue right now, so I'll look forward to getting to this and getting some more insights from both Dallas and Paul here in the next portion of our webinar. And I urge anyone who does have some questions to feel free to continue to post questions in their questions box within your GoToWebinar panel, and we will try to get to all of them as soon as we can. So I'm going to give another second for the polling, and we will move to our Q&A section. So this one, Dallas, is for you. One question from the audience is, how closely should the finance team work with the various groups to help them develop their plans? So one thing is to get the objectives passed down through the executive management team and then through finance, but how much effort or support should finance parlay onto the department heads, et cetera, from a plan perspective?
I think it all comes down to ultimately how capable your users are of using the system and how effective their management is, I guess, at getting them to meet the overall guidance goals that were set down. So what would happen at Crossbeam, for instance, we would ultimately send out goals after the before the offsite, and then they would be refined at the offsite, and then ultimately everybody would have a meeting with their budget managers, and they would kind of be tasked with the number that they had to get to, and so my level of involvement depended on which department. So for engineering, they were very much into their numbers, and they really didn't want finance messing with their plans or budgets at all. Some of my other departments were, heavier touch, I guess, and so I would actually have to work, a little heavier with them in order to help them meet their numbers. Strangely, marketing actually, did a great job of coming up with their budgets. They had a lot of detail that went behind it, and they were able to move through the budgeting process with very little involvement on my part as well. But I would say it's ultimately a matter of, your history with those departments, meeting the goals. Because one of the problems that we would generally run into, we had some turnover between our sales department and as far as leadership. And so I had two different, and we replaced one person with two people. And when you had two separate budget owners that had to kind of get to a total number, it was that was one problem in 1 year's cycle, was that getting both people heading in the right direction from a number of head count and trying to keep their costs low. So I guess it ultimately comes to history with those departments on meeting goals where they need to be, and also the level of realism that they have in the budget. Hopefully that answered the question.
Thank you, Dallas, for that. And now, Paul, I'll ask you the same question, but more from a current process perspective, and obviously transitioning over to more of a rolling forecast. But how much effort do you and your team spend with the department heads and the other folks who are obviously tied down to budget numbers? How much time now versus previously? Can you share some of that with us?
Yeah, I would say we're spending less time with department managers, but the time we're spending with them is of higher quality, more productive time. We're talking about what has happened, how we're doing to budget to variance, and where is the organization going, what are they working on, and how is it going to impact the organization. There's more context to the numbers, I am finding.
Gotcha. Thanks for that, Paul. And now here's a question for you, Paul, and this comes from the audience as well. So how did you create the buy-in when you needed to change process, the procedure, or just looking to implement the technology? I know you said your final thoughts, you would never go back, or never go to another company that has not implemented a CPM, but how did you create that buy-in and get the executive management team as well as sales, marketing, operations to all follow on and changing the process?
It was surprisingly easy. You think you're going to spend some cash and human resources on this project. Everybody saw top to bottom that the organization had grown over basically from 2000 to 2008, and the old system wasn't working. So there was significant momentum in the organization to do something. And then it was a matter of time of evaluating solutions to find one that fit our organization.
Gotcha. And here's another one for you, Paul, and it kind of just kind of goes on to the last question. But what's the best way to get management together around execution? So one thing is to set the objective, the other is to plan against it. But how do you build that rapport? What are some items that you can share with the audience that's worked well for you? And then Dallas, once Paul's done, maybe share some best practices on communication tactics or ways to build that rapport with the team holistically to get everyone behind the same goals.
I would say a lot of it comes down to fundamental project management skills. There was no, I know people were expecting some amazing magic solution that we did at Parteq, who was implementing the CPM solution, but it was part of the whole organization, realizing that there was a need. We met, we discussed, met with the president, and then with each department manager, and along with line managers as to what their needs and what their tools are, what would make their life easy. What are they doing by Excel on their own that the finance department's not providing to them? And once they saw the benefits of what this solution was going to do for them and what input we needed from them in exchange for what they were going to get out of it, it just happened. So I'd say it's more of the organization culture is important for making the CPM solution happen, and not just look at it as an individual process. Dallas, your thoughts?
Yeah, so I mean, pretty much we focus on any of our implementations, where we have the opportunity to have a dialogue with folks outside of the finance team at quick wins. So, is there a report that that's a pain for you to get right now that that you would like to be able to see sooner? Or is there a lack of linkage for you to be able to track, certain expense items in your current process, and how can you be able to, track those better and building that out within the implementations? I would say that's a crucial component of, ultimately getting management behind a project, and then also kind of engendering faith within the management that, you've got everything headed in the right direction. And then obviously being receptive, because sometimes you build out a solution and you as the implementer build it out with your thoughts on how data entry should be done, and your audience may very well have they may think that you're being overly arduous in your requirements at the level of detail, or they may think you're not being as detailed as you necessarily need to be for their needs. And so just being willing to take that feedback and run with it and building it into your solution. And that's one thing I've found that helped me in my previous role within the industry, was willingness to change the solution to meet folks' needs, but also make sure that it works for everyone else. Not just letting one group, I guess, drive the whole organization. And also customizing the solution to make their lives easier for planning.
Yeah, if I could just, if I could just add on. Yeah, I just found it also important that we didn't make the CPM solution run the organization. That we needed a solution that fit was what we're doing. That we weren't going to change systems and processes because a piece of software told us that this is the way to do it.
No, that's a valid point. So I mean, on to that kind of question, thought, Dallas and Paul. I mean, and this is more to Dallas, but Paul, feel free to jump in as well. But how successful, have your clients been, Dallas, and even in your, when you were practicing, in implementing a technology, such as a CPM solution, to improve the financial processes as well as the performance? I mean, can you give a number, or can you give a sense of likely to succeed, or very kind of high success rate if implementing technology, or is it still driven by process plus technology to kind of get to the end goal?
So how much of, I'm sorry, just to summarize, it's how much has changed through process versus technology?
Yeah, and then how successful have your experiences been implementing technology solutions in the CPM space to improve not only the process but also performance?
Okay. Yeah. So I mean, it definitely depends on the level of detail that people are currently doing for like their long-range forecasting. Sometimes that can, depending on how the solution works, it may or may not hamstring you, I guess, from the standpoint of doing long-range planning. But I generally find that budget cycles and reforecasts, I mean, some companies never reforecast because, it's such a process just to do it in Excel. So by being able to generate a reforecast, I feel like you're ultimately adding value immediately, and also that's a major improvement in the process, because when you're analyzing a variance against budget, so many things may have changed that it's no longer, obviously it's no longer relevant, but you can't even pinpoint why the variances are there anymore because you may have totally changed your expense. So I would say 9 times out of 10, most companies see some level of improvement within at least their ability to generate reports quickly and to make actuals available, and that generally, makes the users' ability greater at that point in time.
Great, thanks, Alex. And go ahead.
The other thing I would point out was in my former life, it used to be, literally a week-long process every time of, updating Excel templates just to, at one point in time to start generating kind of just a weekly headcount reforecast. And, that got down to where it was like a couple hours on a Friday. I could do it within the system and spit out an expense report, and I could see all the variances. And so that was, my predecessor used to have to work until like 3 in the morning, many days to meet the reporting goal that she was asked to do. And I could, once we had the system implemented, I always joked and said I was the Maytag repairman. As long as my people were feeding in the inputs, I was able to spit out the report relatively easy by the end of the week. We did give a weekly expense number, and the CFO wanted to know what was changing within the week regarding the forecast and the numbers.
That's fantastic. The Maytag repairman, I'll have to use that one next time too. So I'll give you credit though, Dallas. This question actually goes for Paul. It's a two-part question, Paul, and I'm going to try to. There's a couple questions in this, so I kind of just want to get to that point. How long did it take for your company to implement your chosen CPM solution? And then were there things that you can share with the audience on things to watch out for, from people resisting to change and how you worked with them, and issues that you might have come up with that you've dealt with, and whatever you can share around that will be appreciated.
Yeah, no problem. It's actually been a learning lesson over 4 years as we keep building onto our CPM solution. We just keep adding and adding to it and getting more benefits out of it. But to go back to 2008, the initial implementation was fairly quick. Most CPM solutions now are sophisticated enough and customizable enough with that nice balance between too customized and not customized, that it wasn't a painful process, the actual implementation, and it didn't take a long time. I think we had it out and going within a month or so. But keep in mind, we are a relatively small organization on that end. Lessons learned, especially lessons learned as we've evolved through the process, is to take a holistic look at your organization, and it goes back to many of the points Dallas mentioned. Go through those slides of Dallas and put in, at the same time as you're putting in your CPM solution, put in your best practices for budgeting. Don't just use a CPM solution to replicate Excel. You're not going to get the benefits. We've found change how you do your budgeting, and I found then we get greater buy-in from management and staff with the solution. I hope that answers your question, Carlo.
No, it's great, and kind of just adding to that, I'm going to go ahead and share the answers to the first polling question, and I'd like to get your and Dallas's kind of thoughts on it. You should be seeing it on your screen now, but the question is for the audience, which of the following is the highest priority area for finance and accounting improvement? And it's interesting to see that the analysis and KPI dashboarding is kind of the majority, followed by budgeting and then reporting. And just to add to that, there was a question asked by the audience members on, with that in mind, 47% of them felt that that was the highest priority. Finance and accounting is still responsible for the month-end close, quarter-end close, and year-end close of a business. And obviously the CPM solution can really make that more efficient. And what are some of the things that people should be thinking about when they are in that close process to really take a step back and start analyzing the results, i.e. identifying the trends, better understanding the variances? And is there any KPIs that you guys leverage or recommend to be using within that process?
All right, Dallas, do you want to go first?
Yeah, so it's basically my thoughts on, what the answer here. Yeah, I would say that, you have to get the budgeting and reporting side of things squared away first before you can even focus on the analysis side. And then when it comes to key performance indicators, I think it's very important to include some non-financial drivers. So, customer satisfaction, as far as that might, as far as how that might impact your renewal rate for maintenance, for instance, on if you were like a network hardware or software product, things like that. So not just looking at pure financial drivers, but also to incorporate key performance indicators and also incorporate those as drivers within your planning as well. And then most of these budgeting and CPM solutions generally also offer, a KPI and dashboard functionality within them. And, if you're really leveraging it, you'll be providing that level of functionality to your users. And ideally, it's, somewhat self-service in that they can kind of maintain their own dashboards and, do levels of drill down through the dashboarding solution that they have.
Yeah, I would agree with Dallas of what we're seeing in our organizations. I am seeing more demand, more questions, requests coming from presidents, executive directors, managers to have the analysis, the KPIs, the dashboards. They want to be able to log into their computer in the morning and see which needle on the dashboard is pointing in the right direction that needs their attention. They don't want to be reading through 30 pages of financial reports to find that one problem area that's needing their attention. So yeah, I think this quick poll accurately reflects what we're seeing in our organizations. Carlo?
No, thanks for that, Dallas and Paul. And you know, I wish we had more time to get to the next polling kind of results, but just looking at the time, I know we're kind of getting to the top of the hour, and we still have about a little bit over a dozen questions. So if you guys are okay, we'll follow up with both Dallas and Paul and make sure that we get all of the questions asked during today's webinar answered after the event. So your patience in the audience, and apologies for not getting to all of them. With that said, and just kind of moving the show on here, just a few last housekeeping items before we do end the webinar today. At the end of the webinar, you will be presented and prompted to participate in the short survey. We truly value your feedback and appreciate your time to help us continue to deliver great content. And at that time, you can also easily request to connect with the speakers, both Paul and Dallas, as well as the sponsor, Proformative, with a click of your mouse. And also, please continue to, this great discussion and join us on Proformative.com to share insights and best practices with peers. And if you have any questions regarding your CPE, please contact Chris Brower at Proformative.com. Just a quick reminder to everyone on the phone, we are about less than 2 weeks away from our inaugural Proformative conference in the Bay Area on March 20th. We look forward to having everyone there. It's a free event. Come and learn from great world-class speakers on best practices of new technologies, specifically related to the financial technology space, and working with your peers on determining, such as today's webinar, getting great insights from both Paul and Dallas on best practices, lessons learned. It's a great event, and we hope you check us out at Proformative.com. And we do have the third and last polling question coming up, but I just wanted to take this time to thank both Dallas and Paul for their time and insights today. Both speakers are great leaders in their field and excellent sources of information on the topic of best practices around financial planning. And we really appreciate your time, both of you, Dallas and Paul. Thank you.
Thank you, Carlo.
I also want to thank, again, our sponsor today, Proformative. We truly appreciate their support and the support of the speakers to bring you the great content and knowledge that we have shared during today's webinar. And now, before we do end the webinar today, I will go ahead and launch the third and last polling question. And you should be seeing that here momentarily on your screen. And again, this is just a reminder, anyone who's here for CPE credits must answer all three. So we really appreciate everyone participating in today's webinar, and we thank you, the audience, for taking the time to join us today. We'll hopefully give you back a couple minutes, and if I can please ask you to just spend another 60 seconds with us after I close up this webinar. I will end, close up this polling question. I will end the webinar, and a brief survey will pop up. At that point, you can ask to request to meet with the speakers and connect with them, as well as the sponsor. And you'll also have the opportunity to sign up for the Proformative event with the click of your mouse. So I'll leave this open just for another second. And I thank everyone for their time today. Have a great rest of the day, and we look forward to seeing you back at Proformative.com. Thank you.